think, not in 5,000 years have we seen sustained short and long-term bond yields before. I think at the very least, that represents a non-negligible chance of a very bad outcome. So one of the themes that I hope to kind of come back to in the debate is how an asset allocator should build in that very bad outcome into his decision-making. And I think the second point I want to make is what do persistently low expected returns mean for the asset allocator? Should he accept the lower returns? Should he take more risk, either through leverage or within the capital structure? Or thirdly, should he try to exercise more skill, either in a trend towards more active asset allocation, dynamic stock picking, etc.? So again, I think these are two very important themes for the panel to debate. We have a very distinguished panel today that's going to help us work our way through the tangled maze, aka the global opportunity set. So I thought we'd start with the growth outlook. We've just heard from the macro panel, fairly mixed panel in terms of their views, but I think on balance a more favourable, optimistic outlook. So perhaps I could start, Charles, with you. I think through much of last year you wrote that you were very concerned about recession in the US. So perhaps you could tell us where you stand now and how that's impacting your view on asset allocation.
Thank you. Will I speak in a microphone somewhere? Yeah. Good morning. Very happy to be here. I will start with perhaps the negative interest rate, which is an important development. You see, when I was a young student at Toulouse University a long time ago, I learned that interest rates, I was being paid interest rates to basically compensate me for the uncertainty of the future, which made plenty of sense to me. It didn't bother me a lot because I had no savings whatsoever at the time, but that was perfectly all right. And then, you see, if you accept this idea, which I think is central to economics, then you cannot not think that with negative interest rates, it means philosophically that the future is more certain than the present, which is a total stupidity. The future cannot be more certain than the present, period. So if the future cannot be certain for the present, then how do you operate a capitalistic system without the help, for example, of a discount mechanism? You cannot operate an earnings discount model with negative interest rates, period. So since we basically our tools are, if we are entrepreneurs, the market prices, all the market prices in the world are determined by two market prices: interest rates, which basically is a relationship with the future, and exchange rate, how much do you produce at home and how much do you produce abroad. For the last 15 years, the central banks all over the world have been desperate to manipulate these two prices to achieve results that they, in their great wisdom, thought were going to be good. Which means that since these two prices are false, all the prices in the world are false. And it means that the entrepreneurs cannot make a decision. We are basically in a situation exactly like the Soviet Union, with no cost of capital and no cost of exchange rate. So we may have growth, we may have no growth, but what I'm saying, it's an utterly stupid system.
Okay. Harry, you were very concerned at the back end of last year as well about rising US recession risk. How do you feel now?
Well, basically I built an indicator. Sorry, no,
does this one work? Does this one work?
Yeah, sorry, I thought it was a question for me. I only think the question is for me.
Yeah, I mean, look, the US cycle has been based primarily on cheap money and rising asset prices and wealth effect. It hasn't been based on all of the high quality ingredients that you would look for economic growth to be based on, like investment and capex and productivity and trade. It's a cheap money story. It's been a story of very low wage growth, which has been positive for companies. And of course, it's been a story of a shale oil boom. And we know that's dying a death, a pretty painful one. We know that cheap money is being taken away. I think we're much further into this Fed tightening cycle than a lot of people would think. And we know that wage growth is now picking up as well. And that's translating into a squeeze on corporate sector profits. So I think the key foundation pillars of this cycle have been removed. And now the US economy is looking very vulnerable. And it's not just the US, of course, it's globally. Look at CapEx. Globally, it's contracting 15% year on year. Even if you take out energy and basic materials, CapEx is still contracting at its fastest pace since the global financial crisis. And look at global earnings, they're contracting. Look at global trade, it's shrinking. And dollar liquidity is tightening up. We live in a dollarized world. It's the dollar that matters. Euro and yen liquidity, of course, is loose, but really it comes back to the US dollar. 2/3 of the world's trade is done in dollars. Most investment portfolios, as you know, are dollar denominated. Emerging market financial systems, they're dollarized. You tighten dollar liquidity and you cause soft growth globally. At a time, of course, when we're now seeing a lot of that weakness feed back into the US. So it's pretty clear from the indicators we look at, from the analysis we've done, that a US recession risk is relatively high. Now, it's not 08, 09, but it's 2001, it's 1990, it's a shallow, mild recession in which companies retrench. They draw down inventory, they cut capex, and then eventually they cut jobs. So I think that's the outlook for the US, and then with that, of course, the outlook for equities and other asset classes, other risk assets, is a bear market. The primary trend in equities is down, and I don't think that changes until we get a response from the Fed.
Can I ask, just in terms of the impact of the growth outlook on asset allocation decisions and choices, how are you translating that view into portfolio choice or asset choice? And maybe we could talk about the pricing of recession hedges as well. If we'll take that all.
Well, shall I? Let me take an alternative perspective. At cross-border capital, what we do is do something very different. We're not really interested in forecasting economies. We think economies are the outcome of the process. And what we look at is money flow. Money flow, to our mind, is the most important thing to understand. And for the last 25 years, that's what we've been monitoring and providing clients with data on those money flows. I think the significant point about asset allocation is you've really got two decisions. One is to decide what are your safe assets. And let me say that the safe asset choice varies over time. So for example, now it's government debt and cash people regard as safe assets. If you go back to the 1970s, those were the risky assets. Real estate and commodities were the safe assets. So the first choice is, what are your safe asset basket? What should you be asset allocating around? And we think that's largely a choice about the underlying inflation background of an economy, demographics, regulation, and those sort of factors. The second thing to look at is, how do you then choose between asset allocating between risk assets, of which one can put equities, corporate debt in that, or safe assets, and let's say that's, at the moment, government debt and cash. It's basically looking at money flows and the direction of capital flows in markets. And that's how we undertake our asset allocation process. If money flow into financial markets is increasing, we want to go more into risk assets. If money flow is exiting, we want to move out and protect ourselves in terms of safe assets. One of the most important guides to that is to look at the slope of the yield curve in markets. Now, although interest rates, as Mike has said, interest rates are at very low levels, negative right across the spectrum, the yield curve slope has been pretty much invariant over decades. One of the most important pieces of research that we've seen probably in 20 years came out of the New York Federal Reserve about 12 to 15 months ago. And what it said was that 80% of the movements in the yield curve in the US are down to term premium movements. Absolutely nothing to do with policy interest rates, in other words. It's all to do with risk premium. And those risk premium are basically money flow determined. When there's lots of money in the system, investors will shun safe assets and they'll move into risky assets. If there's a shortage of liquidity, they'll go back to safe assets. And that's what drives the yield curve, the term premium, and the allocation between risky and safe assets. At the moment, the money flow background is not very good, and it's not very good for two reasons. Number one, the People's Bank of China is tightening. It is not easing. There's a great misunderstanding of what China is doing. It's been tightening for the last 15 months, which is why the situation is bad. And secondly, the US corporate sector, which I think Russell alluded to in the previous talks, is losing cash flow very rapidly. And whatever the political outcome, watch US tax rates next year and the year after. They're going to start clobbering corporations, as we're seeing worldwide.
Tim, can I pick up on policy and liquidity that Michael's alluded to? We've seen a pretty tight relationship between central bank balance sheet growth over the last couple of years and liquidity and general asset prices. How long can we expect the recent ECB actions to keep markets sweet? What's your broad view on liquidity trends and impact on markets?
Well, I think we should start with the basic point, which we often say at NDR, that money moves markets, and that's been the case since the bottom in 2009. We've made the point, really starting in 2012, that we'd entered a new era for allocation, and that the best strategy over the long term is to use market declines as an opportunity to reallocate out of bonds, which are at the end of the secular bull market that started in the early 1980s, and into equities, which started the secular bull market in 2009. Since 2009, equities have outperformed more than 15% per annum on the S&P, more than 10% per annum on the All Country World Index. The point is that this liquidity has continued to underpin equities. And from an asset allocation standpoint, we can debate the various policies, but the point is this has been an ideal backdrop for stocks. The markets climb the wall of worry. The worry has been negative interest rates are going to have unintended negative consequences, that the economy isn't going to respond to all this liquidity. Yet the economy, and one point that people I think don't recognize, is that as of the middle of last year, if you look at G7 GDP growth, it actually was at a 10-year high. There are certainly a lot of things to be worried about in terms of the global economy, but this liquidity that's been provided is having the intended effect, and that's what the equity markets are telling us. The stock market is the best leading indicator of the economy, and it continues to work its way higher. So what we do when we see this kind of cyclical bear market that we've been through, we think about this as a buying opportunity. And one of the things that people point out often is that when we've had this decline, and is the market cheap enough? Well, in a non-recessionary environment, clearly the market is cheap enough for a bottom. In fact, what happens over the course of a secular bull market is the market works its way higher to higher highs and higher lows in valuation until you get to the kind of major level of overconfidence, speculation, over-leverage like we saw in 2000 when PEs get up above 30 or even higher than that. So everything we look at, I think, supports the idea that this secular bull market is going to continue. We will go through periods of volatility as we come out of this negative interest rate policy back towards zero interest rate policy, back toward normalization of policy. We'll probably get through more bouts of volatility. That's to be expected. We just had one, we'll have more of these. But the difference is they're not going to be the kind of decline we saw in 07 to 09 when the market was down 50% on major benchmarks. They're going to be these kinds of 15 to 20% setbacks that's going to take valuations back down to a higher low and set the stage for a new advance. And we've just been through one of those, so that's why I think 2016 is going to turn out to be a very good year, probably double digits. Actually, the year after a weak year within a secular bull market, as we define as 5% or less, the market's been up 26% on average. So that's a pretty strong number to think about, and that's kind of where we are now. So I think a lot is looking positive for equities, and again, I'd sort of also remember markets climb the wall of worry, so I would focus on the longer-term trend right now.
Thank you. So in the context of a looming recession at some point, perhaps we can shift to the role of government bonds in the portfolio. I think it's fair to say that most institutional investors still hold probably between 40 to 60% of their government bond exposure in developed market bonds, fixed income exposure. On our analysis, we expect sterling investors to lose about 1.7% in real terms over the next 5 years, holding developed market government bonds. So one of the questions I want to put to the panel is, does it make more sense in this context to hold cash than developed market government bonds? And how well do you expect developed government bonds to play their typical defensive role in a portfolio in the next recession? Charles?
Well, may I say that you have bonds and bonds? When I look at the bond market, basically I'm trying to find something which has the same volatility as the stock market. Let's assume that we are in a deflationary period, which I believe is the case. Capitalism is returning to its deflationary roots. When you are in an inflationary period, bonds and equities have a positive correlation. There is absolutely no point in having bonds as a diversification. It returns less, and it's not interesting. When you are in a deflation, the correlation becomes almost perfect, negative with government bonds. So if you put a 50-50 portfolio, which you manage all the time, you have outperformed the stock market by roughly 50% for the last 10 years, 15 years, 20 years, 5 years. And there is no point in history in the last 25 years where you haven't had a 10-year period where bonds outperform equities. Not one. Now, when you look at in the past, when I was a money manager, I used to buy bonds. See, because the central bank in Germany was serious. But as one of my friends said some time ago, the world is finished, and I asked him why. He told me, Charles, when the Pope is German and the central bank are Italian, what do you want us to do? Which I think the guy has a point. So the point that I'm making is that there is absolutely no diversification value whatsoever in the European bond market, period. It's a license to lose money. Which leaves you with only one bond market, more or less, to hedge. It's a US long-dated bond. The volatility of the US bond, the stock market is roughly the volatility of a 22-year US zero. So if you put a 50-50 portfolio with a US zero, which was my recommendation since last August, you are at 104. The stock market is around 90, the S&P. The world index is around minus 13. And the bond market is up 17%. If you go from 3 to 2 on the 22-year zero, you're up 50%, which will take care of a 50% bidding in the stock market. Now I would like to comment on the notion of bear market, and then I will pass the microphone. I've been around for quite a while, and you have two kinds of bear market. What I call the gentle cut, minus 20, it's a pause that refreshes. As soon as you're down 20, you review your buying list. And I've known three, Ursus Magnus, massive bear markets. 73, 74, 2000, 2003, and of course 2009. They are minus 50, minus 60, minus 70 bear markets. Every one of these three bear markets was preceded by a long period of negative real rates, or negative rates altogether. Why? Because that's what favors a misallocation of capital. You see, if you basically give money to a real estate developer, real estate will develop. If the money is free, people will do stupid stuff. So we have already had that similar amount of stupid stuff that has been done in the commodity sphere. I'm not sure that it's the only place where stupidities have been done. So what I'm saying is that it has been the longest period of negative real rate in the history of humankind. It has lasted longest than the Second World War. So I suppose that you have had massive misallocation of capital in the market and that they will emerge slowly. And to conclude, bear markets are like dynamite fishing. You throw a stick of dynamite, you see the small fish coming up, and then it's only when you see the whale that you start buying. The problem that I had is last time I saw the whales coming with Bear Stearns and Northern Rock, and I said, let's buy. And you had a whole bunch of whales that were still going up, I didn't know. So what I'm saying is this time I will wait for all the whales to get up.
Can I just follow up on that, Charles? I think we would agree with your view that the place to be is long bonds in the US. Clearly, they're going to perform well in a recession outcome, as they always do. And you need to hold those as well as cash. But can I just come back to the point you made about bear markets? Our view is the that the US appears to be rolling over into recession, with that as a bear market, and I actually doubt that it's going to be a 50% bear market, as I think you're alluding to. It's not like 2008 and 2009. Now, you're right, we've had very negative interest rates for a prolonged period of time and throughout this cycle, but the misallocation of capital hasn't been in the US. That's not where we've had a credit boom. In fact, private sector debt in the US has gone down as a share of GDP. The misallocation of capital has been in China and other emerging markets. The theme of the last cycle has been hunt for yield. So we've had capital flows into China and EM, and that's where the misallocation of capital has been. That's where we've had huge credit booms and asset price booms. And of course, the response of central banks in emerging markets has been the same as every central bank since the early 70s and the end of Bretton Woods, which is inflows of capital prompt them to print a lot of money and slow the appreciation of their currency, and that sows the seeds for credit booms. And I think that's where you're much more likely to see 50% type corrections in asset prices. That's in China, and I think people are far too complacent about China. Private sector debt in China has gone up 100 percentage points of GDP in 6 years, and people don't seem too worried about it. I think that is a sign that we're headed for a financial crisis in China. In fact, Daniel Kahneman, who many of you may know, wrote this book, Thinking Fast and Slow, and in it he describes two very interesting ways of thinking. One is the inside view, which is if you're in China, it's okay. They're under control, they've got a command economy, they've got a closed capital account, they've got lots of reserves. It doesn't matter that they've had huge credit boom. And then the outside view, which is the one he suggests you should take, is what happens when your debt ratio goes up by 100 percentage points of GDP historically. Let's look at the facts. Well, 100% of the time you have a financial crisis. So let's make that the starting point for what's going to happen in China, and then think about where we might be wrong. So really, I think the risk in terms of the global macro outlook is tied up in China and other emerging markets, and not in a very large bear market in the US.
Thanks, Michael. You described China as the world's biggest credit bureau. I think maybe, do you want to comment on what your signals and work is telling us right now about the near-term outlook for China, but also in the context of how China might exert its influence on monetary policy in the West, and how we should perhaps position our portfolios around that theme?
Okay, quite a lot to talk about. I think the first thing to say is that if you look closely at what the People's Bank of China is doing, and that's one of the things that we do, the Chinese People's Bank has been tightening monetary policy over the last 15 months. I mean, that's been absolutely clear. A lot of people have misunderstood Chinese actions because they look at interest rates very closely and don't factor in the fact that China is trying to deregulate its financial system. And in doing that, there's a lot of interest rate distortions, and many rates in the system are falling. The key thing to watch is the balance sheet of the PBOC. And the balance sheet of the PBOC currently, as we stand, is about 15% below its trend level. So it's running at a level of about 29 to 30 trillion yuan, whereas the trend would take you to about 35 trillion yuan. The PBOC, by the way, is the world's biggest central bank. Its balance sheet is about 20% bigger than the Federal Reserve, so it matters. Now, the PBOC has been essentially doing this because China, as we know, has been losing a lot of capital at a rate, I think Charles early on said, about 100 billion a month. That's pretty much correct. The interesting point is that that is flight capital. It is not really debt repayment. We know that because if you look at companion data for Hong Kong, what you see is Hong Kong equally is losing a lot of capital. And if it was repayment of debt by China, Hong Kong banks were receiving quite a lot, and they're not. So it's flight capital. One of the things to link up, because in financial markets there are no unrelated events, is why are government bond markets in the G4 yields are so low, and why is the dollar so strong? I would argue that a lot of that is to do with flight capital from China. The interesting perspective in the short term is, and 1 month doesn't make a trend, is that the February data that we got out last Thursday would indicate that that 100 billion a month average has dropped to now about 40 billion. So there's a big step down in the February data. February was obviously a holiday month, so it may be irrelevant in the big picture, but it looks as if China is throwing so many roadblocks at the system and making it difficult to export capital that maybe they keep it over the cracks. Now, what are those cracks? Those cracks are pretty big. And the cracks are significant because what we've witnessed in the last 20 years is the world's biggest ever credit boom. The asset economy in China from 2000 to today has grown by 12-fold. You have never seen bubbles deflate gently in that situation or nicely. It just doesn't happen. China in many ways looks like Japan, so you might say, well, okay, on a benign scenario, perhaps they can struggle through over the next 20 years and growth slows down. The consumer is impaired, but maybe we get through it. That could be correct. The more interesting story to tell is what happened in the Soviet Union. And if you look at the Soviet Union in the 1960s and 1970s, the growth rate of the Soviet Union was at very similar rates to what we've just seen in China, rates of 8 to 9% per annum. The only body that was really monitoring the Soviet Union at the time was the CIA in America. And every year when they looked at the data, they used to predict that the Soviet economy would fall off a cliff next year. But year after year it kept going. And the reason being is it's very easy to create growth in capital spending in the economy if you're corralling lots of resources into it. If you're building ships or mining coal or producing steel, it's very easy. The really hard bit is to create consumer-led growth. And I would define anyone to come up with an example of any economy in the last 100 years that has seen a sustained economic growth rate of above about 4% that's been consumer-led. The only example that comes close is Korea, but nobody else really satisfies it. Even if you go back to America in the 1910, 1920 era, that was capital-led growth. And as soon as America switched to consumer-led growth, the economy had hit an air pocket and growth came right down, which is why the Depression occurred. Look at what happened in the Soviet Union when they switched in the early 1970s to consumer-led growth. The growth rate came right down to about 1 to 2%. That led on to Gorbachev and his reforms, and we know that the economy subsequently became toast. So the real concern looking forward in China is this switch to consumer-led growth. It is extremely hard to create consumer-led growth in the long term. People, we think, are way, way too optimistic about Chinese prospects.
Yeah, I can follow up on that. I think we should, this panel is about asset allocation. So, if we're going to make this effort toward consumer-led growth, what does that mean for where we want to think about investing? And I would keep something really important in mind, and I talked earlier about secular bull markets, is that we can compare bull and bear markets, and we think about equities and commodities. What characterizes a secular bull market in equities is consumer sector outperformance, things like, now again, we're talking about where within the market we want to focus on. The consumer discretionary sector, healthcare, consumer staples, these areas do very well and tend to outperform the commodity-based sectors like the resources and energy and materials over the course of the secular bull market. That's been the case since 2009. The longer-term theme for positioning has to be in line not only with the consumer-based sectors, but the consumer-based economies. If you look at the US, Europe, and Japan, they have a relatively heavy share of those consumer-based sectors, whereas UK index has a lot of energy, it's relatively heavy in resources. Pacific ex Japan, emerging markets, and Canada, which has a lot of resources. So if we think about it from a regional standpoint, and then think about it from a sector standpoint, and then think about commodities, and then look at the secular trends, what we find is that in secular bull markets and equities, and I've been talking about the secular bulls since 2009, but we can see the same thing from the secular bull from 42 to 66, from 82 to 2000. The prior to that, it was in the 20s, 21 to 29. Generally speaking, commodities tend to move inversely. Commodities tend to be the secular bear market. We think about what happened during what we used to call the China-driven commodity demand theme from 2003 to 2010. Well, most of that was within a secular bear market in equity. So we get to 2010. One thing that China's been able to do pretty well is control its bubbles. So, China was overheating. Actually, in 2008, China was overheating. 2007, 2008. Then along came the global recession to sort of calm things down. China didn't really have to do anything. But in 2010, they made a concerted effort to control that bubble. Much the same way that even last year they were able to control their bubble in equities, and they brought that down. So China is able to control these things, or has been able to do it successfully so far. But the point is, it does, and I would agree with the point that you do still have the fear of a currency crisis, that somehow they're going to mismanage the currency, and we're going to see things get out of hand in China. It does remain a potential risk, and this is consistent with emerging markets, anything commodity related, still being in a secular, relative bear market, within which we'll have good rallies. And I think that's where we are right now. We're going to see emerging markets have a good opportunity now to come back and sort of close the valuation gap that's happened after this decline and this long period of underperformance. So, we'll get these sort of cyclical periods of outperformance, some of these more resource-related areas, emerging markets, China, but it doesn't necessarily mean it's going to be a multi-year run. And I think all the concerns people have mentioned here on this panel have been, are really things that are going to sort of keep a relatively high risk premium on China and some of the other emerging markets.
Well, let's stay on EM, because I think, in the context of the last 5 years where we've seen EM equities underperform DM by about 40%, as the EM to DM growth premium has fallen from around 5 to 2.5. At the same time, funnily enough, as investors began ramping their EM exposures in 2011, I think what's interesting over the last month, 2 months or so is, at least on the measures that we follow, we've seen a significant bounce in EM real activity that at least consensus forecasters haven't quite picked up on yet, at the same time as we're seeing an outperformance of EM equities, and positioning in the investor community, which has fallen dramatically in the last year from their overweight. So I'd ask the panel, obviously Tim, you've just talked about it, but is there a bigger buying opportunity here for EM? And if so, do you want to highlight any particular areas, equities, bonds, particular markets? Karen?
Well, what we've seen in recent weeks is a classic risk rally, what we would describe as a bear market relief rally. Sentiment's picked up, we've brought forward the timing of Fed rate hikes. All the key risk barometers in the global spectrum have bounced quite nicely, oil and so on, and of course emerging markets. And as you allude to, we've seen 1 or 2 data points improve. I'd be quite skeptical of a lot of those. I think this is a short-lived blip. And for example, you look at China. Some people say, well, look at for example the pickup in M2 growth. That's encouraging. You look at leading economic indicators; they're just starting to turn higher in China. I think these are the kind of data points you're referring to. But actually, you look at M2 growth in China; it's really driven by M1. And the reason why M1 growth is good is because demand deposits have increased, and that's because they've lifted the cap on what commercial banks can pay deposit holders. So it's been driven by M1. Actually, you look at the difference between M1 and M2, and M2, that data is still slowing quite markedly, and it's perfectly consistent with much slower credit growth in China, which is an economy, I think, which is moving from credit boom into a period of deleveraging. So I would treat those data points quite skeptically, and I think it's a blip. Personally, I think emerging markets remain a centre of stress, particularly for as long as the Fed remains on a tightening trajectory. Their financial systems are dollarized. You tighten up dollar liquidity. That's what's putting emerging markets under pressure.
What I find strange, and everybody's talking about emerging markets as if they were one. It seems to me that you have 2 kinds of emerging markets. Commodity producers guys who tend to be in Latin America, and the commodity consumer guys that tend to be in Asia. Everybody has been bothering me for the last 2 years about the big tax cut given to oil to the US consumer, the European consumer. The Chinese consumer just received a $700 billion tax cut, which is much bigger than all the other guys put together. So what I'm saying is we should perhaps split between the 2 kind of the 2 kind of emerging markets. And if I start to find companies in emerging markets that have rising sales, I don't see why I should not include them in the portfolio, since I believe very strongly that we are in a classical deflationary period, as I already said. The criteria of selection for equities is sales. Because if you have falling sales, it means that you're selling goods that are inelastic to price. And if you move into a deflation depression, the variable of adjustment becomes profits and you're dead. So my only criteria for selecting equities is sales. If they are up, I'm happy. If they are down, I'm out.
Can I just come back to that point that you make, that emerging markets should be split? Because on one hand you have commodity producers, on the other hand you have consumers. Of course, when you have a large consumer like China, and they're hit with a shock and they stop consuming so many commodities, there's a shock immediately transmitted to the producers of commodities like Brazil and others. So actually they are linked through the commodity prices, and I think they can be bundled together in that respect as well. And then the other point I'd make is that they're very similar in other ways. They've all had huge inflows of capital, which have sowed the seeds for credit booms. And with those credit booms, you've had this misallocation of capital, you've had asset price booms, and now the opposite is happening. Capital is leaving, and they're all responding in a similar way. They're drawing down their FX reserves to stop large devaluations in their currencies, and that's tightening up their financial systems. So there are lots of common themes. I think you can link a lot of these EM economies together.
I have a big problem with the capital flows out of China, if I may say so very quickly. The Chinese currency was pegged to the US dollar, was paying interest rates, the US dollar was not. So you have something which we call in French termaillage, which means that everybody was long the renminbi or the yuan, and everybody else was short the dollar. 3 months of import and export is $1 trillion, so when they started to float in August, I just tell people, okay, out of the $4,500 billion of foreign exchange reserves in China, 1,000 is borrowed reserves, 3,500 are earned reserves, and they are going to lose their borrowed reserves. And so what? You have had no or very low capital flows out of China, but just an adjustment, an accounting adjustment through the balance of payments. I don't see why I should get excited one way or the other.
Let me sort of try and say something about emerging markets and sort of link it in. I mean, we look at data and we're driven by data. So what I'm going to say is sort of very much related to what the current data is saying. If you take a look at the US dollar first of all, in terms of our assessment of what drives currency markets, it's very much about the quality of liquidity and capital flows. And what we mean by that is that if you look at what drives the currency upwards, it tends to be what we call private sector liquidity growth. Things like corporate cash flow or household savings. Those are key factors which are positive behind a currency. What's negative is when the central bank prints money, and that's clearly, I think, something that everybody would agree. Why has the dollar been so strong in the last 4 years? It's largely been because outside of America, many central banks have been printing money. And inside America, the US corporate sector has basically delivered a huge windfall cash flow gain, which has actually attracted a lot of investors back into the US currency. What you're seeing at the margin now is a crossover of those effects. And basically, US corporate cash flow is starting to come down, and some of the other central banks, for example, the People's Bank of China, may be moving towards some sort of period of ease. And to our mind, what the underlying cross currents would reflect is dollar weakness that we think is coming up. Our greatest conviction is the price of gold, because we think that many other central banks or policymakers will try and keep their currencies weak. So we think gold is going up. And as a result of that, because if you look at the correlations historically, a strong gold price is really a key signal of other commodity markets moving up within about 6 months. Now, you would expect in that environment that emerging markets, and certainly the commodity-related emerging markets, should do well. Now, if you look at capital flows, we monitor capital flows on a monthly basis across about 80 countries. What you find is the capital flow cycle to emerging markets troughed in October of last year. And I think that's quite a significant event. It's now picking up. Will that be a short-term cyclical blip or a long-term secular one? I don't know, but it is bottoming from extremely low levels. And if we're correct that you're seeing a weakness in the dollar, which has been the major constraint on emerging economies, and you're seeing commodity prices rising through this year, I say mainly because of dollar weakness, not necessarily economic strength, that emerging markets can do extremely well. And that's really a key driver of our asset allocation there. So we're reallocating. And as a corollary, if you start to look at the dynamics of commodity-related currencies, they are looking a lot more favorable as well in terms of capital flow dynamics.
Yeah, I guess I'd follow up on that. I agree with a lot of those points. I mean, what I would focus on as well, and I'll get back to the other question about emerging markets in a moment, but the dollar basically, if you think about the appreciation of the dollar, really reached its peak around the end of 2014. And what happened at that point is, we've heard a lot of negative talk about earnings coming out of companies like Caterpillar, the exporters in the U.S. are getting hit. And, so even Yellen started mentioning this, the Fed started referring to the dollar strength, and effectively then what this did is this pushed out when the Fed was going to be potentially raising rates. So what that did is changed expectations for the currencies, and then the dollar came back down. So effectively, the Fed managed the currency by being concerned about, saying they were concerned about earnings as a negative impact of the dollar strength. So since then, basically the trade-weighted dollar has been in the trading range. We haven't, and if anything, a more recent development has been this recovery in commodity currencies like the Aussie dollar and Canadian dollar. And this has been consistent with the recovery in commodities. And going forward, the dollar has still been overvalued on a parity basis. But when you have this sort of environment that's lingered where really we have sort of competitive valuations, and when you have real rate differentials so compressed around zero, you really don't have an opportunity for any currency to really run away on the upside, as we've seen in other cycles when rates are at much higher levels and you have much wider spreads, especially in terms of real rates. So I would expect what we're going to see here going forward, and this is consistent with sort of that secular backdrop I mentioned, where equities are a secular bull and commodities are a secular bear. What happened during past secular bears in commodities is commodities tend to have, and gold is the same thing, you tend to have that initial big decline. After that big decline takes place, what tends to happen is commodities go into trading range. That happened in the 1950s. We saw during that one, also during the 70s. Actually coming out of that, equities went into a secular bear and commodities went into a secular bull. But in a secular bear in commodities, it doesn't mean that commodities are going to continue to spiral lower. What's more likely to happen is you're going to get these rallies, which I think we're in now. I agree. I think probably over the cyclical standpoint, we're going to see continued uptrend. But it's not going to be sustainable, and this relates to what I was saying about emerging markets. And for equities, that's what we want to see, because the equity market wants to see they want predictability. They want to know where commodities, where exports costs are going to be, where imports are going to be. The trading range is very supportive of equities, and we've seen this before in past cycles. Commodities have been in secular bear, moving in more of a trading range environment, and then equities benefit from commodities and their inverse correlations with currency. So currencies and commodities remaining in trading range is equity friendly. And also getting back to that secular trend and to segue into the question about what emerging markets. One way to think about this is to think about the emerging market. If secular trends are really all about the more consumer orientation a market has or a sector has, the more likely it is to take part. Well, if China can pull off this transition toward consumption over the long term, it'll have a better chance of taking part in the secular trend. If it can't, if it remains more commodity oriented or more dependent on commodities, then that's going to be a negative. Whereas you have a market like India, which continues to surprise in the context of other emerging markets, which is more consumer-oriented and has clearly been beneficiary and has behaved more like a developed market in a secular bull. So I think that's one way we can think about like who's going to benefit over the longer term. And I would say it's going to be those markets that can really become more consumer-oriented.
Thank you. I want to move the discussion to credit. US credit, particularly high yield, recently appeared as one of the very few asset classes on our screens to offer significant risk-adjusted value and opportunity. I'd like to ask the panel their views on credit more broadly in this environment, and what type of exposures in terms of sizing within a global portfolio they feel is appropriate for the credit asset class.
Well, look, I mean, on our strategic asset allocation portfolio, we have a zero weighting in credit, and we have done for several years. That's zero relative to benchmark. So we'd expect credit spreads to continue to widen. Our view, as you probably know by now, is that we're likely to roll over into recession in the US, in which case credit spreads continue to widen, primary trend equities is down, it's a risk-off world. Now, how far do they need to widen before they're worth buying? I mean, look, we're about 1,000 bips on the US high yield credit. I think probably we go another 200-300 bips higher. And I say that because a lot of that's been driven by energy. And in fact, if you strip out energy, the credit spread isn't that high. It's back at Eurozone crisis levels or thereabouts. If you look, for example, in the 2001 recession or in 1990, it tends to go a little bit higher. So we'd see credit continue to widen out. I mean, look, from a, you could begin to average into some now. We'd rather wait until it's an even more attractive opportunity. So the trend in credit is widening spreads, unless, of course, the Fed step in with some loose money. And I don't think they're about to do that. I think they're probably on pause for now. If not, they're going to carry on with their tightening rhetoric.
Okay, just credit hits you usually where you don't expect it. You see, that's the so everybody's looking at corporate credit because that's where the two disasters occurred in 2003, 2004, and 2009, and that's where you really lost a ton of money. There is one country which is about to go bankrupt, which has a lot of debt, and it's Italy. So if you look for a credit event, you should look at Italy. Italy has a debt, the non-performing debt in its banks, around 13% of GDP, not of capital, of GDP. And of course, it's a byproduct of the euro. The guys have borrowed euro, and then they became non-competitive, and the Italian industry is going bankrupt. So if you look if you're looking for interesting credit events, look at Europe. There are going to be plenty of them in the near future.
Yeah, I think one of the developments we've seen here recently has been sort of supportive of this overall transition from risk aversion, risk appetite, has been how well high yield has done and how spreads has started to compress, and now the ECB has kind of done its part to sort of perpetuate this trend by buying bonds. But I think about high yield in the context of this whole environment, which I keep getting back to since 2009, and how correlations have changed in ways that nobody would have expected. The fact that you have bond yields and stock prices positively correlated, the fact that energy and equities are so positively correlated. These are anomalies we did not see in past cycles when you had maybe a less deflationary focused environment. But it's been all about deflationary worries since 2009, and as long as that continues and you have competitive evaluation or competitive QE going on globally, you're going to see these, as long as inflationary fear remains front and center, that's going to continue. So if we look at different asset classes, what has the highest sort of risk-on correlation? It turns out it's high yield. High yield is clearly a risk-on proxy, and now when we go through these periods of risk-on, high yield's going to do better, spreads are going to come down. And over time, you'll probably see high yield do better if, in fact, we're in a secular bull, then they're going to benefit from the risk-ons until we start to normalize. The Fed normalizes policy eventually, other central banks start to follow. Then we're going to start to see these correlations come back down to earth. And that's something we need to continue to watch. Watch how the correlations are changing in the context of how policy is starting to normalize over the long term, and that's all going to require that economic growth come through. I'm a little more optimistic on the economic outlook in the U.S. in particular, so I am thinking that the economic backdrop can support this happening. It's going to take time, and in fact, maybe when we finally do normalize, and maybe the whole secular uptrend is thrown into question, because at that point in time, the central banks broadly are behind the curve on inflation. They want to be behind the curve on inflation, and they're going to find out that this is a real problem when inflation comes back and bond vigilante starts showing up again and bond yields start spiking higher. Then valuations are going to will look a lot worse for equities, both on an absolute and a relative valuation basis. With inflation in the picture, real GDP growth is going to start to falter. And then if by that point we have valuations stretched up to, say, 30, 35, which can happen over the long term, maybe that's the end of the secular bull market, and then we have a whole different environment on our hands. But I think for right now, I would say credit's probably well supported. We're not at the point we were at in 2007. We were in the subprime bubble. The housing bubble was coming down, and spreads were extremely compressed. And this is a sign of a lack of liquidity, and it's overconfidence, and really not recognition that a lot of this stuff was about to unwind in a negative way. We're at the opposite end of the spectrum now, from which spreads can continue to come down, and that'll support high yield. I think credit looks pretty good.
Could I make a stupid remark? One of my clients, very big in the US, is managing a lot of bond funds. He told me last month that on 90% of his bond fund, they haven't had a transaction on 90% of the position for the last 6 months. So the whole credit system in the world is becoming like a huge Ponzi. The guys that come in basically allows the guys that want out. But if all the guys want out, the market will stop, will become dysfunctional and will close. We are today probably in a systemic risk with the bond fund in the world, allowing a daily liquidity with basically something which is not liquid. That's something that I would like to mention. There is a market risk in the market. Yes.
Okay, I think we are running out of time, but I think before we break for questions, I'm just going to put the panel members on the spot and ask them for one high conviction idea or theme or expression of their view on portfolio construction. Maybe Tim.
Buy equities.
Okay, I would say for this year, look at commodities and gold.
Basically haven't changed for quite a while. 50-50 long bonds and 50% in equities. It doesn't matter where, providing they have rising sales. And this portfolio has outperformed everybody inside for the last 15 years or so.
Well, I'm going to say sell equities. And I think the reason why I'm so different in this position versus Tim is, and I think, correct me if I'm wrong, Tim, is that you see a relatively strong consumer in the US that saves the day for the US economy, because quite clearly growth isn't coming from other parts. But what I'd say is the US consumer is very different to what it was like in the 90s, which is the period everyone is comparing the US consumer to. In that time, they were re-leveraging, they had good productivity growth, wage growth was strong. Actually, it's very different now. The consumer's de-leveraging. Median incomes in the US have been going down in this cycle. The average household hasn't had a recovery. I saw a stat the other day that 45 million Americans are still on food stamps. It's the same number as it was in 2008. We haven't had a recovery for the average consumer in the US. Everyone talks about the stimulus of the oil price fall for the consumer. Well, guess what? The savings rate has gone up following the fall in the oil price. So the consumer is structurally weak. They're not prepared to spend the gains from oil, they're saving them. And the consumer's not going to save the day. And so with the tightening Fed, I think the primary trend in equities remains down. So I'd say sell equities. As a theme, I'd be very nervous about the outlook for China, and as a result, we'd be interested in trades like short the renminbi, a basket of CDS on China-related assets, CDS on Chinese government bonds, and so on. So that's where we are.
Thank you. I'm going to throw it open to the floor. So if you have a question for the panel, please raise your hand. Please.
Tim, you mentioned about I'm an equity investor, so I'd like to be with it. But I have just a question on a couple of points you mentioned. One is on the technicals. I'd be interested for a bit more depth on what you're saying on the technicals, where you talk about a secular bull market, higher highs, higher lows. I mean, at least short-term technicals look like we've broken down on those. But if you look at global markets and even recently on the US market, so I'd be keen to know, are you looking at a different time frame, maybe a longer-term time frame? And then the second point on sectors, you look at the sectorial leadership, as you quite rightly say, it's been clear, it's been consumer discretionary, healthcare, technology, the staples have done well. Some of those also look like they've broken down technically, healthcare in particular. So I'd be keen to get your thoughts on that. And then we look at three things: fundamentals, valuations, and technicals. We talk here about technicals, and then linking that with fundamentals, you talk about bull markets ending with 30 times PEs. The profit cycle is clearly a lot lower, and we're seeing negative profit growth. You could X out materials, but that's like me saying X out my worst performing stocks. So, if you could just answer those 3 points, starting with the technicals, that'd be really helpful.
Okay. So, briefly, I'm trying to be brief on this. On the technicals, one thing we look at, in fact, if you look at the internals of the market, you want to look at market breadth, look at things like advancing volume, total volume, percentage of stocks above their 10-day moving averages, percentage of markets above their 10-day moving averages, and so on. What we saw back in 2009, which was actually the highest we had, in August of this year, We had, when it was sort of the market got complacent coming into the summer, the PE on the MSCI World Index was around 20. People were sort of, I would say, amused by the bubble in China, but didn't really take it too seriously. When China started coming back down, and then worries about the valuation started entering the picture, worries about deflation being exported out of China, sort of drove this, what we call waterfall decline. And then you have the selling climax on August 24th, where we had the highest intraday volatility since 2008. And that's usually the point of maximum panic and fear. A lot of our indicators got down to like 0% of stocks above their moving averages, extremely high negative downside volume. And then what we started looking for at that point was to see a non-confirmation on the retest, because you can always expect the market's going to come back down and test the lows. And so that's what happened. But on the retest at the end of September, it happened with less downside participation. And then the third development that has to happen is you want to see what we call a breadth thrust, when the pendulum swings in the other direction. So you have more than 90% of stocks and markets above their moving averages, and that's what we saw in October. So we had everything sort of lined up, and we had a breadth thrust. And then what happened, the market sort of went sideways for a while, and then you had this second wave of deflationary fear when energy entered the picture, and that brought us down in January. And we did the same thing that happened then. We had the market came back down in January, tested in February with less downside participation and less confirmation, had another breadth thrust after that. So if you look at this, then the real question right here is, well, if we fail yet again, then that probably is saying, well, maybe the economic outlook is worse than we're expecting. Maybe the 2008 comparison starts to come into the picture, because from that point, 2008, we had a similar situation. The market came back down, tried to rally, didn't hold, came back down in the second half of the year, and we know what happened after that. So I think it is a key. We're at a key point right now, but one thing I would say, though, is what we didn't have toward the end of last year was confirmation from some of our longer-term indicators based on, say, 50-day moving averages, 200-day moving averages. Those indicators did not confirm, and that was a kind of telling you, well, maybe the sustainability wasn't there for the recovery. That has changed. As of last week, we started getting some signals coming through that we didn't have in the fourth quarter. That's been very encouraging. Now, what I think we need to see is to have this continue and to see even more decisively. We could break above the December highs. If you get up to 2,100 on the S&P, for example, these would all be, I think, reassuring that actually this time the market's actually ready to get going. So I'll be watching all of this. We're actually overweight equities by 5%, but I'm ready to add further exposure if we get additional confirmation. The second question on the sectors, healthcare is a tricky one, because one of the things we would expect to see when the market's on the defensive and declining in a cyclical bear is you're going to see pretty reliably what happened. The defensive sectors tend to be healthcare, utilities, telecom, and consumer staples, and they did outperform. Now, healthcare is a little bit different, because healthcare took on a sort of a growth characteristic last year as biotech became such a big influence. So in some ways, healthcare coming back down was first a sign sort of that sort of a negative momentum aspect coming into the picture, where some of the leaders started to lose out. And then more recently, healthcare's decline has been more of a reflection of the market coming off of this defensive mood of moving from risk aversion to risk appetite. So what we've seen recently, pretty consistently, healthcare, consumer staples, telecom, utilities have all been underperforming. And the other thing, there are three things we wanted to see. We wanted to see that's happened. Second thing we wanted to see the real focal point of the selling pressure and worries about deflationary fear, the materials and energy sectors. We wanted to see those come back. That happened. Those sectors have been outperforming. That's been good. And then the third thing, the third leg down of the decline was sort of driven by this negative interest rate fear and how it was going to have a negative impact on banks in Europe in particular. And now we've seen the financials start to outperform. So we've seen the sectors have been performing as we would want them to. I would say, financials are interesting here. They're clearly the cheapest sector entering the year. They've gotten even cheaper. The banks, we made a point that European banks look good. So I was thinking a little bit contrarian about financials, especially since they're starting to show some relative strength. And I think the third question was about corporate profits. I think this gets back, it sort of relates back to the first part, is that if the market doesn't get going, and we do lapse into something that makes maybe the 2008 comparison seem more relevant, then this tells us, well, maybe we're not going to see the growth come through. If the growth doesn't come through, then the profit margin outlook, we can see profit margin coming off of their extreme is usually pretty negative background. So really, we need to see the growth come through to support top line growth and have profit margins supported, and then you can start to see the momentum start to continue to build for equities.
I would like to ask how to comment. If I will follow secular stagnations why all asset allocation is different, because most of the research is based on almost 25-year data. So, and also I think the headline secular stagnation may be alarming, but the underlying theme that the equilibrium interest rate has fallen below zero actually can reconcile the bearish side and the bullish side. So in the past, when you have negative interest rate, you have misallocation of capital causing price. But now actually negative interest rates are cause of lack of investment, capital been falling, excess saving. So
Sorry, just to recap the question, your question is around the impact on growth of the negative interest rate and misallocation.
The question is how asset allocation would be different if Larry Summers' secular stagnation is correct.
Well, you see, Larry Summers is a high priest of a church called the Keynesians, who believe that low interest rates create growth. And I can go on any history economic book, low interest rates do not create growth. That's very sad, but it doesn't work. So the fellow is following the wrong economic policy. The wrong economic policy allows a very low growth to occur. And then he says, you know what? We are now in a structural problem. Structural is the excuse that economists use when they don't understand something. You see? Basically, I wrote a paper 5 years ago called The High Cost of Free Money, in which I said that negative rates or low interest rates were going to lead to low growth, low productivity, high Gini ratio, this is the coefficient, high social tension, the emergence of demagogues. Okay, I wrote it 5 years ago because it happened every time when you had very low interest rates. So, give me a break, there is nothing wrong about the economy. The monetary policies are totally silly. But that's because we have in power guys that are from a church and not scientists. That's all. They believe into something because they have a profit. Fine.
Shall I add something? I mean, I think that I think obviously if there is secular stagnation, it has to affect asset allocation. But it affects it in terms of what is the choice of safe assets. And I said that there are two decisions one makes, the split between safe assets and risk assets, what goes into the safe asset basket. In a secular stagnation, I think you basically have to change that mix because the inflation background would be different. And in that sort of environment, you would want to have fewer real assets and probably more financial assets like government bonds and cash.
Okay, I think I have time for one more question. Yeah, thanks.
I just wanted to bring the focus back to the emerging markets and the commodities. And Tim has touched on it briefly. So we've got the producers, Russia and Latin America, and we've got China, and it's slowing down the imports of commodities. Where do you see India in that and its failure to pick up the slack so far?
Well, I mean, all I can say is I can come back and look at the sort of data that we look at. One of the things you see in terms of emerging markets and the pattern of data and capital flow recently is that a lot of money has gone into the safer emerging markets, things like Korea, Singapore, to some extent India, in the last few months. Money has started to trickle into some of the medium risk markets, which you might include in that China. And money has not yet started to go into this sort of the deep, risky, more cyclical bits, like Brazil, South Africa, and Turkey. So I think there's a sequence in terms of money flow. In terms of what drives emerging market liquidity in the longer term, we look at three boxes. One is capital flow by foreign investors. The second is what the private sector creates, and this is largely coming through from corporate-driven liquidity. And the third is what the central bank does. If you look at most emerging markets, with India is actually a very interesting exception here. Most emerging markets in the last 5 years have seen a collapse in their private sector liquidity generation. In other words, corporations in those economies have really struggled to generate cash flow. And most of the liquidity that's come through in those economies has not been foreign investors, it's been central banks, which of course is why the currencies have been weak. Now, India is an exception because in actual fact, almost uniquely amongst a lot of these emerging economies, their corporate sectors are quite cash generative, and so the backdrop is better. What's affected India slightly adversely in the course of the last 6 months is they did lose quite a lot of capital outflow in the back end of last year, but that seems to be coming back right now. So the longer term prospect looks, I think, pretty good for India longer term.
Yeah, I would reiterate that. That's, as I mentioned earlier, this has been one of our longer term calls. It's been within emerging markets, well, with more consumer-oriented markets in general, but India in particular. We've been bullish on them. What we like to do is we have a way of rating different markets based on both technical factors, based on momentum, deviation from trend, and so on, as well as valuation factors. And valuation factors include ROE, long-term earnings growth expectations, and earnings yield. So you put that together, half and half technical, half fundamental. India's been at the top of our ranking system really for the vast majority of the time over the past several years. There's a lot of sort of qualitative reasons for thinking India can benefit, but it also comes through in our more quantitative work as well. So I think I would say that's definitely a place to go if you think about emerging markets.
I'm getting eyes from over here. Thank you to our panel for a very insightful discussion. I'm sure they'll be available over coffee. And